I don't really rule out Bitcoin ever doubling in a year. I mean, it's
Mhm.
Bitcoin. But I tend to have more conservative price predictions, which I think there's a good chance we can get back up above 100 this year. Um, you know, before all this kind of tariff kerfuffle, I would have,
Kerfuffle, yeah.
yeah, kerfuffle. I would have had a higher, I would have had probably a higher price target. Um, if I imagine a scenario that brings us to very high prices this calendar year, it would probably be because some massive liquidity unlock happened. Like, let's say
Mhm.
the U.S. bond market broke, the Fed came in and like basically did yield curve control or like kind of QE that they don't really want to be doing,
Mhm.
or some sort of big treasury operation twist sort of thing. It would probably take something like that combined with some sort of like de-escalation of tariffs. Sure. So the global reserve currency means that countries around the world predominantly use the dollar in this case for a lot of different purposes. One is international contracts. So when units are determined for what you're going to sell oil in, or even what you're going to sell a lot of other goods in, it's often in dollars, even if it's between countries that both don't use the dollar. It's kind of like the biggest ledger that they all kind of attach to in the unit of account sense. It's also the primary funding currency, meaning that like if an entity in Europe, for example, lends money to an entity in South America somewhere, it could be a government, could be a corporation, there's a good chance it'll be in dollars. Occasionally it'll be in euros. It could sometimes be in local currency, but often it's in dollars. It's also used as a reserve asset. So because these countries around the world have liabilities, either in the contractual sense or the debt based sense, they often also store assets in dollars. And then lastly, it's the most liquid trading unit. So, for example, if you're looking to trade between South Korean currency and Brazilian currency, instead of trading them directly, you'll often trade one to the dollar and then the dollar to the other one. So the dollar is like on one side of the vast majority of FX transactions. And so because it serves all those purposes, it's basically the biggest ledger in the world that all these different ledgers connect to at the top down sense. And so what it means is that there's extra demand for the dollar. And there's kind of a couple different levels of demand. So an emerging market currency, generally there's not a lot of external demand for it other than when you're directly interfacing with that country. Certain large developed countries have a little bit more demand for them, but not much. It's still generally when you're looking to interface with that country. Whereas the dollar, because it's the biggest, most liquid, most saleable ledger out there at the current time, is used for all these different purposes, even if you're not currently using those dollars or intending to use those dollars to buy goods or services or assets in the US. So there's this extra monetary premium for the dollar. And then the next question is, so the whole world needs dollars for all these purposes. How do they get the dollars? And the mechanism that happens is that because they all need the dollar, they're structurally and like involuntarily overvaluing the dollar. If you look at it on like a trade basis or an interest rate differential basis, there's this kind of structural bid for the dollar which overvalues it. And then what happens is that because the dollar is overvalued in the system, it becomes rather uneconomical to produce a lot of lower margin goods in the U.S. It's one of the most expensive places to do it, even compared to other developed peers like Germany, Japan, Singapore, whatever the case may be. It's harder to manufacture in the U.S. even compared to a lot of other wealthy nations. So and it also it boosts our import power. So Americans, because the dollar is so strong, we can travel around the world. We can buy a lot of Chinese goods, and so what that does is that kind of forces open our trade deficit. Um, because it impairs our export competitiveness and boosts our import power kind of artificially. And so what we do is we just flood dollars into the world to the tune of like $1 trillion a year to the rest of the world every year. And that's how they get the dollars. They need to continue using the dollar as the global reserve currency. And so that's why, at least in the current system that's been in place for like 50 years or so, that's kind of why they go hand in hand. They're tied at the hip. People often question, is the global reserve currency good for America? With the kind of assumption that the answer is yes. But like any country, especially one as big and dynamic as America, there's not just one America. It's a big mix of a lot of different things going on together that happen to be in one political entity. And so that status basically empowers certain parts of the economy, certain people in the economy, and then it hurts others. And so, for example, if you're in Washington, D.C., and you want to be able to sanction almost anyone in the world, it's nice that everyone's using your ledger. It makes it harder for any entity to go around it. Not impossible, but your sanctions are rather powerful compared to if Canada's sanctioning you, for example. You get a lot of leverage that you can basically pressure other countries with. You have the rest of the world financing part of your deficits because they have this kind of structural need for assets. It's generally good for the stock market because all this capital, what countries do with it, there's often this thing that people say, well, we're sending them pieces of paper and they're sending us goods and services, which is true, but then there's one more step. With those pieces of paper, they go and buy our financial assets. So they buy our stocks, they lend to our corporations, they buy our private equity, they buy some of our real estate. So we're actually what we're doing is we're selling portions of our appreciating assets to the rest of the world, and we're acquiring some of their depreciating assets, goods and services, which are useful, but they're different than appreciating assets. And so the problem is, so like running a trade deficit for 1 year or a few years is not a big deal. Deficits come and go. Different countries go through these periods. The problem is that when it's structural, due to the reasons I previously described, when you have 50 years in a row of trade deficits, you get a really big imbalance. We've like stacked all the cards on like New York, Washington, Silicon Valley, basically the coastal cities, and we've really kind of kept taking from a lot of the heartland area, except for the farms, but we've taken a lot from all these industrial places. You get political changes, you get national security challenges when you
Yeah.
realize like you're reliant on your military components to a kind of alarming degree, from foreign sources, or you realize that a country with less GDP than you can pump out missiles faster than you can, just because your manufacturing base is not disproportionately bigger than theirs, even though your economy is. So it has various implications as it builds up for decades. So right now in the existing framework, gold is the primary neutral reserve asset that central banks already own. They already know how to buy. So that gets kind of the initial benefit. Bitcoin is the up and comer. So as long as it continues to stay decentralized and secure, I think it'll continue to grow in size. It has the benefit that it has its own settlement network attached to it. It's kind of half the point. Whereas the reason gold can't kind of by itself be the best global reserve asset
Mhm.
is because then you need this like layer of credit on top of it. Whereas Bitcoin can function on its own. In addition, when we've seen these other countries try to go around the dollar, they're always trying to build these like systems to interface with each other. So all these like closed systems trying to figure out how to do cross-border trade. While there's this really powerful open source solution kind of staring them in the face. Now, it is understandable that they've not rushed to it because using the Bitcoin network means owning volatile Bitcoin. It's also still fairly small compared to the scale that the world would need for something like this. So there's some degree of career risk of being early, for example, but it is kind of reaching the scale where I think that countries will increasingly take it seriously. Um, and so both as a neutral reserve asset and as a global settlement network, that's very powerful. In addition, all the existing things already has. Basically, if you're in a place that's authoritarian, individuals can benefit from Bitcoin as well, rather than just countries at the sovereign level. So the kind of the full stack and down, I think is pretty powerful. And then in addition, just talk about AI. It's hard for AI to get bank accounts. It's
Mhm.
easier for them to spin up a wallet, and so I think that it makes sense that Bitcoin is a powerful tool for AI agents in the future as well, microtransactions, things like that. In addition, there's also like a lot of kind of existing software. When they face things like credit card fraud, where you pay for their services and then like cancel, get your money back, they didn't really lose much by giving you that service temporarily because it's a high margin business.
Mhm.
Whereas AI services are pretty hardware based. They actually incurred a cost.
Yeah.
And so they have a higher stakes in avoiding things like chargebacks and fraud and things like that. And one of
Mhm.
the advantages that Bitcoin is at least done certain ways, it's final,
Mhm. Mhm.
which matters more for certain types of payments than others. So I think that Bitcoin fits in multiple ways into this vision of the future. My guess is that we end up higher at the end of the year than we are now, at least. There's a lot of variables that could affect that. So I think that most days where you have a big down day in markets is probably not going to be a good day for Bitcoin, just because most pools of capital treat it as a risk-on asset. It's still small, it's still volatile. A lot of times, especially because it trades 24/7, if people are worried about how things are going to open on Monday, some pools of capital can sell their Bitcoin on a Sunday and prepare, right? So the 24/7 can sometimes add to its volatile pricing, especially when TradFi markets are freaking out because we're talking about like a sub $2 trillion network compared to this like multi-hundred-trillion-dollar global behemoth of interconnected finance and leverage. So Bitcoin, I think, will get shoved around by volatility. As this kind of settles a little bit, if you do get ongoing capital outflows of the US, that actually could be good for Bitcoin. Sometimes people ask, what could make Bitcoin more meaningfully disconnect from the NASDAQ? But one is anything that hurts NASDAQ margins, but that does not hurt global liquidity, which should generally be somewhat supportive of Bitcoin, minus certain particularly volatile periods. But then it more structurally impairs the Nasdaq, the S&P 500. We saw similar to this in the closest period to maybe look at or study is the 2003 to 2007 period. That was the prior weaker dollar cycle. There wasn't this kind of like mass excess of capital, but there was around the margins. Capital went to emerging markets, capital went to commodities, capital went to gold, capital went to these other assets. And so US stocks were not really the place to be, and a lot of other assets were. And I think if we encounter like a 5-year period like that again, that could be a period where Bitcoin does pretty well, even as the stock market, the US stock market, doesn't do particularly well. That's kind of how I view it. I think volatile but favorable.
Well, we started the year around 93, 94,000. Are we still in a bull run, Lyn?
Short answer is I think longer term, yeah. I think that Bitcoiners got very attached to cycles. And I think especially as the asset gets larger, those cycles become less clear. Anytime a lot of market participants think they know how something works is when it tends to change. So just when all like TradFi market participants were like, well, bonds always go up when stocks go down. As soon as they all know that, that's when it stops happening. Because it's already fully positioned for, and then it's not going to happen. Basically, everyone's seen the Bitcoin cycle so many times. They expect there to be a cycle, and cycles can change. And so I think it's less about the halving cycle. It's more about the liquidity cycle, but liquidity is complex in this environment. We've at least taken off some tail risks of politics for the next few years. So Bitcoin has always had kind of this like embedded probability of like, what if the U.S. takes its gloves off and just goes after Bitcoin really hard, right? Because I would certainly tell every major financial institution in the U.S. that you can't custody your own Bitcoin. Kind of go after it. That's at least off the table for a while. So I think that a lot of the fundamentals look pretty good at the current time. So I expect pretty good performance over the next year or two. But it is subject to not having like a 30% market crash or things like that could, temporarily push us lower that we'd have to then rebuild from.
Welcome, everyone, to the Market Chronicles, episode 16.
Great to be here.
We're about to dive deep, give you a really sharp understanding of some key market forces. And hey, if you're catching this on YouTube, definitely hit that subscribe button. We've got plenty more analysis like this lined up.
Yeah, don't miss out.
So today, we are really zeroing in on some recent thoughts from Lyn Alden. Brilliant analyst.
I'm always insightful.
We're looking at her take on Bitcoin, naturally, but also the bigger picture, the whole global macroeconomic landscape.
It's all connected, right?
Exactly. Our mission today? Pull out the key insights on Bitcoin's price, the U.S. dollar's huge role, and the future of neutral reserve assets. Should be good.
All right, let's get into it. Starting with Bitcoin's price. Alden's view is, well, it's nuanced.
As always with Bitcoin.
Right. She acknowledges, Bitcoin can always surprise. A yearly doubling. It's possible given the volatility.
Sure, we've seen crazier things.
But her general stance is, let's say, more conservative, usually. Remember, she did float the idea of maybe getting back above $100,000 this year.
I do remember that. Felt optimistic at the time.
It did. But these new tariff concerns seem to have, tempered that a bit, put a bit of a damper on that specific forecast for this year.
Okay, so that $100K this year is maybe less likely now, in her view. But what could still push Bitcoin really high this year, according to her? Is there a scenario?
Yes, she outlines one. It hinges on a big liquidity event, a significant one.
Like what kind of event?
Think something disruptive in the U.S. bond market, something serious enough that it forces the Fed's hand.
Ah, okay, so forced intervention.
Exactly, like yield curve control or maybe more QE, stuff they'd probably rather not do right now.
Right, under normal circumstances.
Precisely. And crucially, that big liquidity injection would need to happen alongside de-escalating tariffs. Less trade friction.
Got it. So it's a combo deal. Big liquidity push plus smoother trade.
That's the mix Alden suggests could really fuel a significant Bitcoin price rise this year.
Makes sense. Okay, let's shift gears a bit. The U.S. dollar. Alden gives a great breakdown of why it's still the king, the global reserve currency.
Yeah, she really lays out the different facets. It's not just one thing.
So what are those core pillars she points to?
Well, first, it's the main currency for international contracts, pricing, settling trade deals.
Okay, number one.
Then it's the primary currency for cross-border lending, funding flows around the world.
Right.
Also, countries hold huge amounts of reserves in dollars. It's a key asset for central banks.
Still the main one they hold.
And finally, it's just the most liquid currency in the forex markets, easiest to trade.
So all that combined gives it this, what did you call it? Extra value?
An extra monetary premium, that's her term. Basically, because you need dollars for so much global activity, there's this built-in structural demand.
Which props up its value.
Yeah, often leading to it being, somewhat overvalued compared to just domestic fundamentals.
And that overvaluation, it sounds good, maybe, but it has real consequences for the U.S. economy itself, doesn't it?
Oh, absolutely. Big ones. An expensive dollar makes U.S.-made goods pricier overseas.
Hurting manufacturing competitiveness.
Exactly. But on the flip side, it makes imports cheaper for Americans, so we buy more stuff from abroad.
Boosting our import power.
Right. And Alden argues this is a key reason for our persistent trade deficit. We basically send dollars out and goods come in, partly to satisfy that global demand for dollars.
It's a cycle.
Yeah.
And the effects go beyond just the trade numbers, impacting politics and even security.
For sure, the dollar centrality gives Washington, D.C. a lot of leverage with sanctions, for example.
A powerful tool.
Definitely. Plus, it means the rest of the world effectively helps finance U.S. government deficits by holding dollars and dollar assets.
Which can be good for U.S. financial markets.
Generally, yeah. Surplus dollars often get recycled back into U.S. stocks and bonds, but
Right.
Alden also flags the long-term downsides of running these big trade deficits year after year.
Like what?
Things like economic imbalances within the U.S. Think coastal cities versus the heartland.
Which can fuel political changes.
Plausibly, yeah. And also national security concerns if you become too reliant on other countries for critical manufacturing.
It's a really complex web. Okay, let's talk neutral reserve assets. Alden sees gold as the current main player, but Bitcoin is coming up fast.
Yeah, she positions gold as the sort of established, incumbent neutral asset for central banks. They understand it. They've used it for ages.
A traditional choice.
Right. But Bitcoin is the up-and-comer, as she puts it, and it has a really key advantage.
Which is?
Its own settlement network. It's built in.
Oh, right. Unlike gold.
Exactly. Gold needs layers on top, banks, custodians, credit to actually move value efficiently. Bitcoin theoretically settles on its own base layer.
So the idea is countries might start looking at Bitcoin more seriously for this role.
That's the potential Alden sees. As it matures, proves its security and decentralization, it could become a viable alternative global settlement network, especially when you consider the political strings sometimes attached to existing payment systems.
But it's not quite there yet for central banks, right? There are hurdles.
Oh, definitely. Alden is clear about the current limits. Its volatility is still high, and frankly, its market size is still relatively small compared to gold or major currencies.
So practical challenges remain.
Yes. But she also points out other uses, like its value for individuals living under restrictive regimes.
Sure, a censorship-resistant asset.
And she brings up a fascinating angle. Its potential for AI agents, microtransactions, avoiding chargebacks, things that are hard with the traditional system.
AI using Bitcoin. That's definitely forward-looking.
Yeah.
Okay, lastly, how does Bitcoin fit with traditional markets? Alden often notes it acts like a risk-on asset.
Yeah, it tends to move with risk appetite. When markets get nervous and sell off, Bitcoin often gets hit too, sometimes harder, because it's seen as newer, more volatile.
So it's sensitive to those big market swings.
Generally, yes, especially on the way down. But interestingly, Alden suggests that capital flowing out of the U.S., maybe seeking non-dollar assets, could actually be a positive driver for Bitcoin.
How so? Is there a historical parallel?
She points to the 2003-2007 period. The dollar was weaker then.
Right, I remember that cycle.
During that time, non-U.S. assets like commodities, emerging markets, gold, they did pretty well, even if U.S. stocks weren't necessarily booming.
Okay.
So she suggests Bitcoin might behave similarly in a future weaker dollar environment. It could perform well, even if traditional U.S. assets lag.
Interesting potential decoupling there. So, bottom line, is she still bullish on Bitcoin long term? Is the bull run still on, in her view?
Her longer-term outlook is definitely still positive. But she thinks the focus might be shifting.
Shifting how?
Less emphasis on the rigid 4-year halving cycle that everyone used to talk about. As Bitcoin matures and gets more integrated, that cycle might become less clear, less dominant.
Okay, so maybe not the predictable clockwork it once seemed.
Perhaps less so. She suggests we should pay more attention now to the broader liquidity cycle, global money flows. Although she admits liquidity is super complex right now.
Fair enough. Hard to get a clear read on liquidity.
Very. But one clear positive she notes is that some of the big political tail risks for Bitcoin in the US seem to have faded recently. More regulatory clarity, or at least less outright hostility.
That's certainly helpful for sentiment.
Definitely. So putting it all together, her expectation seems to be for pretty good performance, her words, over the next year or two.
Assuming no major meltdowns.
Right, contingent on avoiding a really big systemic market crash.
Okay, so wrapping it up, Lyn Alden presents this picture of Bitcoin navigating, well, a very complex global scene. Its future tied up with liquidity, the dollar's role, all these big forces.
That sums it up well. It really highlights the interconnectedness.
And it leaves us with a thought, doesn't it? Thinking about all this complexity, financial innovation, AI, decentralized tech, how might our actual definition of a reserve asset change over the next decade? What will that even mean?
That is a big question. What role does decentralized tech play in that future? Definitely something to chew on.
Indeed. Well, thank you for joining us for this rapid but hopefully insightful look at Lyn Alden's latest thoughts here on the Market Chronicles.
Always a pleasure.
And remember, if you are watching on YouTube, hit subscribe. We'll be back soon with more market analysis. Thanks for listening.